Well, let's shift from the fundamental to the technical and see more on what the charts are saying. Adam Turnquist is Chief Technical Strategist at LPL Financial, and he joins us remotely. Adam, thanks for being with us. So when people start talking about this momentum for crude, what are you seeing? Does it look like the real deal?
Thanks, John. Appreciate being on the show. And it does look like the real deal. We've been watching crude oil for the last year. It's been like watching paint dry. We've been stuck in what we call a bottoming process. I think as some of those supply and demand dynamics started to play out, clearly there's been a shift in those underpinnings, and we've seen a breakout in crude oil, WTI, that is above $83. That was the line in the sand to really validate a breakout. We did see some of the momentum indicators confirm that breakout. So it looks like for right now, the path of least resistance remains higher for WTI. We think we could get to $94 to $97. That's some resistance and a key retracement level in relatively short order. So look for some more upside there. We also like the energy sector, clearly a beneficiary of the advance in crude oil.
Well, it was interesting. Bloomberg had put together some industry data suggesting that the number of those who participate in the oil market, so-called net longs, are actually the most significant we've seen in about 15 months. What if you go back over, you talked about the paint dry story analogy. If you go back over the last year and a half, how would you characterize what you've seen in terms of the positioning within the crude market?
Yeah, I think positioning, we had relatively high short speculative positions in WTI in the spring. The Saudis came out with a production cut, surprised the market a little bit. Shorts covered. They made another run at short covering in the spring again. I think the shorts have kind of thrown in the towel on this trade, and now we're starting to see those longs move into crude oil. And if you think about it, it's pretty simple math. It's just we have increased demand, China importing record or near record imports in August, up somewhere around 21% in terms of how much they're bringing into the country. You talked about some of those other production cuts from Saudis and Russia playing into it. And then on the other side, obviously, is just this breakout that we've seen in momentum. So I think the positioning right now for shorts has pretty much been dissolved at this point. I think a lot of those shorts have covered their positions, and we're seeing that long interest pick up.
There obviously was a brief moment over the last year and change where we did see crude prices well above $100 a barrel. I do wonder, you talked about the range you're going to be watching for, which wouldn't quite get us there. But is there anything psychologically that might emerge in the market as we potentially see oil prices moving back towards $100 a barrel?
Yeah, I think psychologically, just the inflation impact. When you go to purchase an airline ticket, obviously we had a huge surge in summer travel, starting to see more travel pick up out of China, and just filling up your gas tank. I think that's going to have a pretty big impact on the economy if we continue to see an advance in crude oil. For now, we haven't seen a major shift in some of the inflation metrics that we look at, whether it's CPI swap rates or break evens, but certainly a concern for the Fed and just overall for this soft landing narrative that we're talking about for the U.S. economy.
Okay, so given that we have seen mostly up days for the balance of 2 weeks, maybe the market just settling out here right now, the oil world is dominated by some of the monthly futures contracts. There are some industry terms such as backwardation that are increasingly getting some attention as well. Can you explain to our audience what that means and how that maybe plays into this story of a tighter supply market?
Yeah, great question. And we've seen that backwardation, meaning the front month contract is more expensive than the second month contract. What that really means is just that it's a sign of tightening oil and a tightener oil market. So increased demand coming into the market as investors are willing to pay up for that near-term contract. We got that signal with the market moving into backwardation in July. So a pretty good signal from the supply-demand dynamic there. And I think it's continued to increase that backwardation. Those contract differentials have continued to show that we are seeing a tighter oil market. And that's really what we're seeing when you look at those supply and demand dynamics playing out across the globe.
Okay, really.